And we were just listening to President Donald Trump speaking there from the Oval Office, a wide range of topics, but of course everyone really focused on tariffs, trade, policies, the signing of an executive order, basically a memo here, directing his cabinet to sort of take a closer look here at reciprocal tariffs. We heard from Howard Lutnick a little bit earlier, who said that they still have to make a decision on that, and by April 1st, maybe April 2nd, they'll have a more definitive decision. Romaine Bostick here alongside Alex Steele. We are just about less than 40 minutes until those closing bells, Alex. And while the president was speaking, believe it or not, I don't know if you were paying attention, we had a little bit of a rally on our hands going on in the markets right now. 612 right now on the S&P, 6,112 right now on the S&P 500, just a few points away from a record high. 6 points
away from a record high. So really driving into the close here, also continuing that rally in the bond market, yields dropping, dollar selling off, kind of different than what you would see if you were really worried about tariffs within the market. Individual stocks, though, still moving, like the defense stocks are getting hit after President Trump said he's going to slash military spending in half.
It's kind of interesting, though. We talk about the drop in yields that we saw today, of course, the weakness in the dollar, and some of that seem to be tied to this idea that the threat of tariffs may not be quite as severe as what Trump has sort of been banging the drum about. And I think this signing today in this press conference, which was, let's face it, a lot of talk about what could happen, but not actually any definitive action. Maybe that's giving the markets a little bit of a relief here.
And also with Mexico and Canada, those tariffs were delayed till March. These are now delayed until April. April 1st is when he'll get the report from Howard Lutnick, the Commerce Secretary. So then what happens April 2nd is a question, and a lot can happen before April 2nd.
Yeah, absolutely. Let's bring Michael McKee into this conversation. He's our economics editor here at Bloomberg News. Mike, let's talk about the potential impact of some of these tariffs, should they actually come to fruition. The market seems to be breathing a sigh of relief because, at least for now, they don't have to deal with this. But if we do get to April and they do have to deal with this, is there going to be a material impact?
There should be a material impact. It's very hard to know because they haven't described how they're going to do this yet, and that's part of the reason maybe the markets are rallying today, because they're sending Howard Lutnick off and telling Commerce and USTR to come up with a plan. So we don't know what the plan is going to be, and it obviously puts it off for a while. But is this going to be on average tariffs from countries, or is this going to be on specific products from countries? This will be like 903,000 different products traded under the codes of the U.S. Census Bureau. So how do you do all that?
But some of the headlines, too. I mean, he talked about this idea of looking at the VAT, basically the value-added tax coming out of Europe, looking at that as effectively a tariff that, I guess, in his view, would end up sort of being subjected to reciprocal tariffs.
Well, this is the part that really starts, if he follows through, the trade war, because he's talking about non-monetary trade barriers, which include things like the VAT tax, which people didn't expect. But there's also
it's just that, Mike. If you say VAT tax,
there's regulations.
I know, I was thinking the same thing.
Sorry.
There's regulations. There are subsidies, currency manipulations, if you want to find that. All kinds of things that they have to put a value on, and then figure out how you're going to tax. And then the question that comes up is, how do you get out of this? What's the off-ramp if all this happened? Because countries spend years negotiating these things one by one before you get any kind of treaties. And now he's starting all over again with the whole world. So you're kind of going back to the days after World War II when you had the general agreement on tariffs and trade, and then the update in the Uruguay round. You've got a whole massive negotiation with countries everywhere. If all of that happens, which is perhaps another reason that people aren't as worried yet, because it's hard to see all that.
And even though we don't know what an off-ramp would be, it does appear that maybe the market's taking it as a negotiating tactic, not necessarily as an actual event.
Well, I'm thinking what the president may want to do is have countries come to him and say, we'll lower tariffs on certain visible things. And obviously, he's had an issue with Europe and agriculture subsidies and automobiles. He says autos are going to be tariffed separately. That's not part of this deal. But if they come and they say, we're going to lower our tariffs on some of these things, then maybe he pulls back from it and we don't get this massive worldwide thing. I can't see any country redoing their individual tax system in order to satisfy the president of the United States.
What I thought was interesting, too, is mentioning specifically Europe and the courts and big tech, and saying that Europe's been very unfair to big tech. Again, that's an off-ramp that I don't know quite how you manage.
Well, that one is probably the digital service tax that he's talking about. And there are 3 or 4 countries in Europe. Europe has sort of agreed on a plan. 3 or 4 countries have started imposing the digital service tax. And it's not much, it's 2 or 3%. But the idea that they're doing that annoys him. And perhaps there's some sort of room to negotiate that. But it's hard to know on a case-by-case basis what's unfair, what's got to change.
All right, Mike, really appreciate it. Really, really great stuff. Super great. He's been in D.C. for decades. He covered USMCA negotiations. Anyway, thank you so much, Bloomberg, Michael McKee. All right, shares of Duke Energy are down by about 2.5%. The company reporting earnings where they raised their 5-year CapEx plan to about $83 billion on increased data center and industrial demand. The company also removed certain language concerning methane emissions and net zero carbon emissions from their statement. We spoke earlier to Lynn Good, the chair and chief executive officer at Duke Energy, about that data center demand in the wake of DeepSeek's emergence and the company's commitment to clean energy.
The strategy hasn't changed. Duke Energy is committed to a future of reliability and affordability, increasingly clean energy as we retire older plants and bring new things on. But to your point around load growth and data centers, we do see an uptick in gas generation that wouldn't have been the case 5 years ago, just as we put together plans on how we're going to serve this load in this moment. So really committed to a future, and we see a bright opportunity for the company as we pursue this growth.
I am curious, Lynn, when we talk about those gas plants and more importantly, some of those coal plants and the longer term trajectory. I mean, originally Duke had made plans to shut some of those plants. I know you've reversed on that partly because of demand, and I don't know how much the new administration is factoring into that. But you take your big facility out in Indiana, that's now supposed to be online, until 2038? Should we expect that to be even extended further than 2038?
Romaine, we have been working toward a 2035 date for retirement of coal, and we really see that as being important because these assets are aging. The supply chain supporting coal has been challenged, and we expect that to continue. But we have always looked at those dates as something that has to be reviewed in the context of what's going on in the business and also within the context of where our regulators are. And so as I think about 25 to 2038, I don't look at that as a huge shift. Duke is not stepping away from a commitment of modernizing our fleet. We're just reflecting the reality of the growth that we see in the near term and how do we maintain reliability and keep bills as low as we can for customers at the same time pursuing our goals for cleaner energy over time.
I'm glad you used the word reliability, particularly in the context of the data centers and AI. There's been a lot of talk amongst the companies, hyperscalers, and some of the other end users here about having reliable transmission here. Was there any shift at all in some of those customers' needs, demands, hopes, based on what we learned out of DeepSeek a couple of weeks ago?
It's a really good question because there's been so much dialogue over the last week about what it means. And I would say to you, Romaine, the tone of the customers we're dealing with, the hyperscalers that we are dealing with, has not changed. They have always expected and shared with us that energy efficiency would be a part of their business model because they know they're big consumers of electricity. How can I reduce that demand on the system over time? Because I also expect my volume to increase. And so as we look at our plans over the next 5 years, we do not see a big impact from this recent event, but of course are continuing to listen for changes in the industry. And as I said, we'll expect energy efficiency to continue to be an objective for the tech companies, and we welcome that because the demand we're seeing broadly is just putting an impact on the system that'll demand more and more resources.
Lynn, the other day I was talking to the Energy Secretary, newly confirmed, and he was talking about coal and extending the life of coal plants. He doesn't think there'll be a renaissance of coal, but nonetheless, I'm curious, Lynn, as to the direct, what would it take for a utility like you guys, a power company like you guys, to say restart a coal plant?
I don't see us restarting coal plants, Alex. And I would get back to the business case around coal. In addition to clean energy over time, these plants many of them 50, 60 years old, where the decisions around how to maintain and how to replace equipment can be challenging when you're looking at a useful life that is, shortened. And so we believe the right answer is to continue to modernize our fleet, continue to take advantage of new technologies so that we are making the right decisions for our customers over the long term. And that has been our strategy at Duke. It continues to be our strategy. And with the growth that we're seeing, this is why natural gas is showing up more strongly than it would have 5 years ago, because it represents a base load resource that we believe matches this load requirement in this moment. And you can see that in some of our plans that we think adding those resources is important in this decade. But we will continue working toward cleaner energy over time, and those plans have not changed.
You have a 5-year capital plan that actually increased CapEx to $83 billion. And I'm assuming a lot of that is going to be that hyperscaler and that data demand. Do you think we're ever going to be in a place where you're going to build like a mini power plant right next to a hyperscaler, or is everyone just going to be sharing the same power on a grid?
I look at this opportunity, Alex, as being a combination of both. And as you can imagine, for customers of this scale that have this amount of demand for power, we are having conversations with them about how we can meet their needs. And it could, for example, include connecting to the grid, but also having a backup power supply that we could take advantage of in a peak period. There will be demand response opportunities, energy efficiency opportunities, and I believe some of them may have an interest in having their own on-site generation. I think what's important is we want to be a part of that part of data centers, artificial intelligence, U.S. leadership and technology. We want to be an enabler of that. And so those conversations with customers are ongoing. And I would say largely those conversations mean taking advantage of the grid for at least some, if not all, of their load. And then some of these other technologies more on the margin at this point.
How cooperative, Lynn, are regulators going to be, not necessarily at the federal level, but at the local and state level?
We work hand in glove with our states and local communities on economic development. And in this moment, we're talking about data centers, but think about expansion of life sciences, think about advanced manufacturing. We have had a long-standing partnership around economic development. And the states see data centers as an important part of economic development, particularly at the local level. Property taxes, for example, that could be important to a community. So we're in ongoing dialogue, also ongoing dialogue with regulators. Their interest is in making sure if we add this load that we're not in some way subsidizing that load with other customers. So those conversations are ongoing. And we have a lot of experience in how to execute those types of contracts. And we see them as being relevant to this moment as well.
Lynn Good there, the Chief Executive Officer over at Duke Energy, the conversation that Alex and I had with her earlier today on the back of their earnings. We keep the show going on as we continue to count you down to the closing bells, and we're going to take a look at what's going on from the sell side. Top calls, big movers on the back of analyst recommendations, and we start with a whopper, Trade Desk, the digital advertising platform missing the mark with last night's fourth quarter earnings report. Evercore ISI downgrading the stock to inline. The analysts now expecting the shares to lose their super premium multiple. This was the first time in 33 quarters that Trade Desk missed its own guidance. The shares down 32% on the day, biggest single day drop for that stock on record. Next up, Target, a cut to hold over at Gordon Haskett. The price target trimmed to $135. The analyst there says retailers are up against an unfavorable backdrop given exit rates that we saw in January, as well as a precarious weather outlook for this spring. Add an uncertainty over tariffs and interest rates, and you've got a lot of pressures on those stores, including Target. Nevertheless, the shares getting a modest bid on the day, up about 1%. Finally, HubSpot, an upgrade there to overweight from sector weight at KeyBank, with the analysts saying the setup for 2025 looks favorable for the AI-powered software company, calling the stock a premier mid-cap growth asset in a market that continues to favor mid-cap growth. The share is up 4% on the day. In fact, at least on an intraday basis, now at their highest level since 2021. Those are some of the top calls there. And we now want to turn to earnings. What's coming after the bell? A slew of earnings, and that includes DraftKings. Analysts bracing for a dull fourth quarter print. This actually comes after a warning that we heard out of rival Flutter after a string of very unfavorable sports results in the U.S. Joining us right now is Bernie McTernan, senior analyst over at Needham. He's got a buy rating on those shares. And Bernie, let's start off with that flutter warning here. There seemed to be some concern here that either we weren't betting enough during some of these big sports events, or maybe we were making the wrong bets that were more favorable to the folks betting and not necessarily to the companies. Was what Flutter said, is that a harbinger of what we're going to learn out of DraftKings tonight?
Yeah, no, it's that the bettors were too good in fourth quarter. And really what we saw in the December and November timeframe is just an unusual run by favorites. And that impacted the sports books. As favorites hit, parlays tend to hit at a greater rate. If you look at New Jersey data, parlays are only 30% of revenue in New Jersey, but they're 30% of handle, but they're 60% of revenue. So they really matter for the sports books in terms of profitability. But what's interesting here is as we turn the calendar, if you look at some of the data that's come out in states, is that actually January was off to a strong start. And then New York actually just released some data in the last hour here on the Super Bowl. And it looks really strong. Overall, New York, it was a 40% hold, GGR hold. That's an enormous number. DraftKings was consistent with that, but FanDuel was actually even better at a 60% hold. So there's, over the past few quarters here, there's certainly been some speculation that maybe the sports books aren't pricing their product right because the bettors are winning more than expected or more than they would expect to structurally. And it seems like those trends may have reversed here in January and into the Super Bowl.
Yeah, absolutely. And we should point out, Bernie, a lot of people were on the wrong side of that bet on the Super Bowl. So I think when we get those results for the first quarter, maybe looking a little bit more favorable for those companies. Just real quickly, when we talk about the guidance that they're going to give, are you confident that A, they're going to give something that's going to satisfy the street, and do you think that they're going to give guidance that's actually going to be matched?
Yeah, so right now they already have guidance out there for 2025. That's for EBITDA of 900 to $1 billion. With the stock getting pretty close to 52-week highs here, I think there's certainly the expectations that they're going to keep that guidance and maybe even increase it. So I think that's the bar that we're looking for, particularly what I mentioned before, too, in terms of, while it's cyclical, there is some, some leeway for the books or for DraftKings in particular in terms of what happened in January in the Super Bowl. So I think investors are, hoping for the high end or maybe even a raise for the 25 EBITDA guide.
Hey, Bernie, how loyal are customers that use DraftKings? Like, is it just sort of the cheapest, easiest bet out there, or like once they hook them, they're in?
Yeah, and what we've seen in states is that, especially in the beginning, when you can go back to the days of 2021 in New York, when all the operators were offering thousands of dollars of free bets, customers were taking advantage and trying out a bunch of different sports books. And what our survey data suggests is that just doesn't happen over time, and that people generally choose a favorite or a primary sports book, and then they might use a secondary sports book to take advantage of maybe an offer or two. But one thing that DraftKings pointed to at one of their investors' day is that revenue retention is actually at least 100%, meaning that they're holding on to their bettors and they bet more and more every year. And that's why you're able to see older states continue to grow, their handle despite being, 4 or 5 years old at this point.
So, Bernie, who are the best competitors then to DraftKings, and does Robinhood become one eventually?
Yeah, I mean, it's an interesting thought on Robinhood. I mean, basically, one of the pain points for DraftKings and frankly, all the sportsbook operators, that they see depositors put money in for Thursday Night Football and then take it out after Sunday Night Football. So there's a lot of payment processing goes on. And so maybe those same bettors are depositing that money in their Robinhood account to go buy, GameStop or Unity, whatever the meme stock of the day is. So maybe there's the potential there for Robinhood. But overall, we think what separates DraftKings and FanDuel from their competition is their product. And so I think that's what it's hard for, existing online sports bettor operators to keep up with the pace of innovation at DraftKings and FanDuel, I think, let alone someone from outside the industry. And I just want to highlight one interesting thing that FanDuel has recently launched. It's called their Your Way product. And it's all sliders. And so there's not the typical presets in terms of, for NFL passing, for example, like a 15 or 25 yard increment. You can say, I want to bet on Patrick Mahomes over, 243 and a half yards and in 57 yards in the second half. And they make that bet for you. That's inherently really hard things to do that, things like AI and machine learning are all enabling. And I think it's going to be a reason why the bigger guys keep maintaining their market share.
All right. Hey, Bernie, thanks a lot. Really appreciate it. Great stuff. Bernie McTernan over at Needham. Thank you very much. All right. Coming up, we're going to take a look at Crocs, one of the big movers of the day. The footwear company reporting earnings that showed better than expected sales and profit numbers. That's today's stock of the hour. You know they have Crocs for dogs?
What?
I just finished this today.
No.
This is the close.
No, blow
on
the
Bloomberg.
break. Wait. All right, time now for our stock of the hour. Taking a look at Crocs, having its best day since 2020 on the back of those fourth quarter sales and profit numbers that exceeded estimates. The footwear company's improving momentum, notably in China and apparently with dogs as well, is a catalyst that could continue into 2025. Jess Menton joins us right now, who leads our equities coverage here at Bloomberg. Jess, this is a feel-good story, right? I mean, Crocs.
It is. To your point, just the size and scope on this today is pretty wild when you see this. So it wasn't even just the backward-looking metrics that beat. It was especially true when you're looking at profit as well as revenue for its 2025 guidance. And specifically, it was led by mid-single-digit growth in its Crocs brand. Have to mention also it owns Hey Dude as well. It acquired a couple of years ago. And that's where it actually had some problems when it came to its expectations. But it did not see a sales decline there. It was actually flat. And that was the first time you saw it not moving lower in about 5 quarters for that specific brand.
What was the forecast like, though? Because whenever we have these sort of one-off quarters, you do wonder if it's going to be a one-off or whether there is some sustainability in this.
Yeah, so it was more of sort of the lower mid-single digits specifically. And so that's what was, because before I think it was supposed to be closer to flat. So the fact that even though it doesn't sound like a lot, for them it was better than expected. But just to put some size and scope, though, when you are looking about where its stock has been and come, especially if you're looking at its drawdown where it's been, it's still off close from those all-time highs, though. But in general, if you're looking at the S&P 500, I mean, it's just about 10% away for the index from an all-time high. But specifically, if you're looking at footwear makers in the S&P 500, that's up close to about 2% today. And then if you're looking at other stocks like Nike, that's up about 1.5%. And then, of course, Birkenstock also up more than 1% today.
I just want to point out, too, there is a high short interest
for
Crocs as well. So I wonder if there's also short covering that's going on there. See, look, Crocs for dogs. Do you see this?
You know, Carol Massar also brought up...
Do people actually buy
She
that,
did
though?
because she listened to me on radio talking about Crocs for
what
dogs.
I was going to say, Romaine was here for this a little over a year ago, but when she brought up the ones that have the spurs on it that look kind of like a Western shoe that they rolled out, and I remember Romaine was pretty surprised by that one.
Yeah, I'm surprised. I just want to know, well, that dog looks like, docile. But I mean, most dogs would not tolerate this, by the way.
Yeah.
My dog certainly.
I don't have a dog, but if my daughter knew that they were dog
I could barely put the leash
Crocs...
on her without her going crazy.
Yeah.
Maybe that's just your dog parenting.
Huh? No, it's her.
Okay. Fair enough. Speaking of the other footwear stocks in the footwear sector, and they're all up as well, have we heard stuff about tariffs in terms of their location, in terms of prices, in terms of where they manufacture yet?
So even though we've had close to about 2/3 of companies in the S&P 500 report, we haven't gotten the majority of retailers yet. So actually Walmart starts it next week, but then the week after that is when you'll start to get more footwear makers coming out as well as retailers. So that's going to be the key moving forward, even though we've seen the majority of the index. But still, nonetheless, you have a big move today in Crocs, but it's still off about 40% for that November 2021 all-time high.
All right. So when we talk about this idea of what we learned from these other companies and the idea of, I don't know, do we really need, more shoes? I mean, I feel like we've been buying a lot.
And the answer is yes.
Well,
but okay.
yeah, I mean, yeah. Well, some
Romaine
people
has
too.
it.
Yeah.
But it gets to this idea, though, too, of how much of this is discretionary spending and how much is, a necessity.
Yeah.
And obviously, we know some of these shoes, people need to buy them for whatever, school, work, or whatever. But when do we get to the discretionary side, and do we have to start worrying about whether the consumer has enough?
And that's something that Gina Martin-Adams and her team at Bloomberg Intelligence have talked a lot about, because when you're looking at the discretionary sector in general for the S&P 500, if you're not, say, an Amazon or Home Depot in sort of the durables type space, that's where the margin pain most has been hit, even for some of the more high-end type of retailers. So that's going to be key too, even with the latest inflation metrics, how that kind of translates. But if you look at Lululemon, obviously that's more of a different type of apparel type retailer, but you've still seen people go and flock more toward the sort of more expensive type of athleisure wear there. So we'll have to see if that translates into, say, companies like Nike, also Foot Locker, and some others as well.
All right, Jess Menton there. A closer look at our stock of the hour. That is Crocs having a phenomenal day here as we move closer to these closing bells. Just about 10 minutes away, and Alex Steele at one point here in the session, it looked like we were going to flirt with another record high on the S&P 500. The high of the day, intraday, 6,114 64.5.
Yeah, the record high is 61.18. So we are definitely getting there, which is not what you would have expected after about a 1-hour presser talking about more tariffs potentially coming online. Tech, though, still outperforming, but within the S&P, the top sector right now is actually materials. And you have to wonder how much of that is related to any aluminum and steel tariffs in particular.
Yeah.
But what's not doing well are those defense stocks.
Yeah, I thought that was interesting. I mean, we talk about some of the stocks that actually moved while Trump was making these announcements. We saw movement in U.S. Steel, but we saw some movement in the defense stocks, mainly because of a comment about, cutting the Defense Department budget in half?
Military budget in half,
seems like unrealistic, but I mean, I guess, a man can dream.
I mean, it also depends on how are we taking all these comments and how nimble do you have to be because of it. The VIX is still really calm, but then you look at the individual stocks and how much they're moving, and that's where I think you're really seeing, it really looks like you're seeing that Trump volatility.
Yeah, absolutely here. As we move closer to the bells, and just a reminder, too, we do get quite a few earnings after the bell tonight, including from Applied Materials, Roku, Twilio, Palo Alto Networks, Coinbase, DraftKings, and a few others. As we count down to those closing bells, let's bring Lynn Goodwin into the conversation. She's an economist and chief market strategist with New York Life Investments. All right, we got to start talking about tariffs and what's going on in Washington. Look, Trump didn't commit to anything today, but again, he continues to sort of rattle this saber, and the market, at least for now, seems to be taking it in stride. And I guess that's because, at least for now, these seem to be tariffs that, if they do come to fruition, aren't going to show up for a little bit longer.
That's right, and the market's been reasonably well behaved, in part, I think, because, of course, growth and earnings have been resilient, but also the 10-year yield has been pretty well behaved. It suggests that the balance of risks that we're seeing with respect to new policy and even global dynamics is at least balanced for the moment. There's a lot of uncertainty about will or won't be implemented. Yeah. But when it comes to tariffs, I have been encouraging my team to think about the long arc of what we're seeing globally, which is that these tariff announcements are not new relative Trump's first administration. They're also not new relative even to the Biden administration. There is a 10-15-year trend in decoupling in the global environment that points to some meaningful investment opportunity, but also risk with respect to price increases.
Does it also mean, though, that a lot of these companies could be potentially insulated from this? I was at a conference earlier this week, and I spoke with a lot of executives who actually talked about how they had lowered, of course, their exposure to China, primarily because of what we saw back, 10 years ago, and of course, then the pandemic. And a lot of them were giving me percentage numbers of what they're getting from China. And we're talking like single-digit percentages for companies that at one point, 10 years ago, were getting 40, 50% of their inventory and supply out of China.
Yeah, that's right. There's been a real shift in where things come from, or if, let's say, there's a reduction in reliance on China in some supply chains, there might be an increase in reliance on other parts of the world, but that security of resources and access to resources, it's become much more important than efficiency and just in time. And one of the reasons I say that can be, and in many cases has been, an investment opportunity is, in some cases, of course, there's company-specific factors that create winners and losers. But this is also a really capital-intensive trend. We're seeing, not just with respect to literal tariffs and supply chains, but also electrification, digitization, the whole sort of fortification of what most countries see as the future of the economy, this access to resources and technology. That's creating doubling down here in the U.S., but also globally.
So when you talk to your team about looking at the long lens of like 10 to 15 years of that decoupling, what comes out of that? Like, is there an investment thesis that you're working with?
It's first and foremost, I think, when we have so much volatility in what's being announced, it's important to focus on the framework that we're working with, as opposed to point forecasts on what the aluminum tariff might be, for example. And so what that results in is a portfolio allocation that's more, at least in the next couple of years, inflation aware. And that means not just your traditional inflation hedges, like a little bit of commodities, maybe a little bit of Bitcoin, which tends to be very liquidity driven, a little bit of gold for uncertainty, but also reminding ourselves that some of the benefits of inflation surprises are sectors like real estate, elements of the digital and energy supply chains, including some of the owner-operators of utilities, really, frankly, boring stuff, but that has cash flow and relatively inflation-resilient earnings. Those are the types of strategies that, while not necessarily winners day in and day out, we see having a long arc, especially when U.S. equity has become so concentrated and top-heavy.
So funny you mentioned that, because consumer staples, that sector in the S&P, hitting a record high. And I was talking to somebody on radio, and they're like, yeah, but it's boring. But is that kind of what you like?
So the consumer story is a bit more complicated, or rather not more complicated, just a different picture from my perspective, because what we're seeing is a real bifurcation in the consumer, where lower income consumers have been really struggling with higher price levels as well as with higher interest rates, whereas upper income consumers have had no problem spending. The result is an environment where both sides of the consumer segment can actually perform pretty well. And so we do believe in the consumer story. We're buyers of that strength, of that resilience. And the GDP numbers from Q4, though of course that's backward looking, showed that consumer spending, always the mainstay of the US economy, is even more outsized a contributor to economic growth. And so if we start to see the consumer stumble, which is not what we expect for the next couple of quarters, we have a broader allocation challenge. Until then, we're constructive.
But what's your general outlook, though, on the labor market? Because we've seen a lot of companies announce plans for layoffs, or at least to sort of reduce their workforce size in the typical amounts, 5, 10%, a couple are as high as 20%. Is this just kind of a idiosyncratic thing, certain companies just trying to trim up, or are we going to see a more widespread reallocation of human resources?
Now, over the course of last year, we saw most of the job gains, and we had really good numbers coming from the government sector, from healthcare, from education, these sort of non-cyclical sectors of the economy, which had us concerned that the labor market was coming into much better balance. But how durable was that? How sustainable was that? Now, in the last couple of months, though, that dynamic of labor supply and demand has started to adjust a little bit. We are seeing the levels of government, healthcare, education, payrolls level off a bit, and other sectors of the economy tick back up. I think where we're most concerned, and frankly, it's hard to handicap, has to do with some of the cuts we're seeing in government jobs now, again, a major contributor so far to payrolls, but also immigration and the cost of labor.
But that's what I don't understand. And I mean, as an economist, I know it's hard to sort of look into the future and say, okay, what's happening today is going to end up, equal this. But when you look at Washington, having lived in Washington for years, I know how much that local economy is dependent on government workers. The uncertainty alone, I would think, would curb economic activity.
I would tend to agree. I think when it comes to the broader labor market, including but also outside of Washington, part of the confidence that keeps consumers spending and therefore keeps businesses making what they're making, selling what they're selling, churning out resilient profits. A big part of that story is that wage growth's been okay, but more importantly, from my perspective, the wealth effect. The market has been doing what, for anyone that has savings, the market has been working for them, not just the equity market, also fixed income markets. You're making money on your money. Now, a drawback in the equity market, from my perspective, is one of the biggest risks to the economy, because it results in a hit to the confidence that consumers have become so accustomed to. Frankly, a jolt in this American exceptionalism narrative that's really driven performance lately. And from my perspective, that's when you start to be concerned about the labor market, which on its own is a lagging indicator. All
right. Well, for right now, the equity market is doing pretty good. Lauren, always a great conversation. Lauren Goodwin, economist and chief market strategist with New York Life Investments, on what is coming close to being a record day. Not quite there, but it's 6,115. The S&P now at session highs. As we move closer to those closing bells, a full breakdown of all of today's action starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele, taking you through that closing bell with the global simulcast. It's already started. Scarlett Fu in the TV studio, Carol Masser and Tim Stenovic in the radio booth as we welcome our audiences across all of our Bloomberg platforms. Here right now, Carol Masser.
Here right now.
With stocks at session highs.
Yeah, I mean, pretty remarkable.
I just wanted to make sure you were paying attention.
I'm a little sleepy, to be quite honest. Having said that, I find it remarkable that with all this talk about tariffs and our own Mike McKee coming in and saying, yeah, this feels like a trade war, that we are seeing equities gain in today's session.
I guess it's because they haven't been imposed yet. And after April is when we'll hear from Howard Lutnick and the president as to when they will be imposed. But I guess another delay is got people kind of okay with this.
Well, April 1st is like a lifetime away at this point, right? I mean, a lot can happen between now and then, including we get 13F filings over the next day or two, and that could be a more immediate catalyst for specific companies.
Also, I want to point out, too, that consumer staples finally hitting that record high. Walmart has up for like 4 days in a row. That's at a record high. So it's still sort of the safety trades to some extent. I mean, materials are also performing that are holding up the market.
Hey, have you checked out Meta lately?
It's down today. It's like a miracle.
It's up right now.
Wait, it went up?
19 straight days. Of course, the longest win streak
and
on
Carol
record.
didn't even put it as one of her gainers. Again.
Oh, Carol.
Do not judge.
I mean, look, what can we do about it?
There's always tomorrow.
But it gets to this broader idea, too, about what's being bought and why. And I don't know if you can even explain this 19-day rally in Meta, particularly when a lot of its peers aren't doing just as well. Nevertheless, let's get you to the closing numbers here with a slew of earnings scheduled to report. The S&P 500 falling just short of that record high, but it looks like it's going to close higher by about 60 points or about 1%, closing right around 6,115. The Dow up more than 300 points or 0.8%. The Nasdaq up about 300 points or 1.5%, while the Russell 2000 getting in on the action as well, up 27 points or about 1.2%.
All right, into the S&P 500 we go. Folks, we've got about 396 names to the upside, so definitely a risk-on trade, more so in today's session. And Scarlett, about 107 to the downside.
Yeah, and take a look at the IMAP. A lot of green on the screen. In fact, all 11 industry groups are in the green, with materials and consumer discretionary and tech leading the way, all up at least 1.5%. Industrials, utilities, and healthcare are, I don't want to say the laggards, but they're underperforming relative to the rest of the market. When you break it down by 24 industry groups, pharmaceutical companies. Wait, I can't get that word out. Pharma companies and life sciences companies, there we go. And capital goods are slightly lower.
You got there. All right, let's get to Roku. Their earnings are just crossing the Bloomberg terminal as we speak. I'm pulling it up here on the Bloomberg. And you've got Roku, fourth quarter net revenue of $1.2 billion. The estimate was for $1.15 billion, so a little bit higher than what the street was expecting. I don't see any other headlines on that.
Well, I mean, just
stock up about 6%, forgive me. But yeah.
Well, I was just looking at the streaming hours. That was up about 17%. But most of these numbers are relatively in line, Carol. Yep. But I think maybe some people are kind of trading on this idea here that with gross margins expanding, with user growth at least stable here, maybe that's will play into a forecast, though I'm not quite seeing one jump out at me.
We got a forecast here. First quarter net revenue of $1.01 billion, smack on what the street was expecting. First quarter gross profit $450 million. That's better than what the street was expecting, $432.4. And first quarter adjusted EBITDA, guys, $55 million, and that is a little bit light, but nonetheless, Roku up about 9%. We got another one.
Yeah, absolutely. Let's get to Applied Materials. That is just crossing the wire right now. Of course, this is a semiconductor equipment company. Just having a little trouble pulling this up here, but it looks like we're getting a negative reaction here with the company saying the net sales came pretty much in line with estimates, $7.17 billion. The street was looking for $7.15, so a slight beat there. Adjusted EPS at $2.38 a share. The street was looking for $2.28 a share. Not much of a reaction in the shares right now, but it looks like the top and bottom line numbers were in line. And as far as semiconductor systems net sales, an important metric, because this kind of ties in to what's been going on with AI. Growth there was about 9.1%, but again, that number, $5.36 billion, was still in line with street estimates.
All right, well, let's take a look at Wynn Resorts. Shares higher in the after hours right now by just about 3%. The company came out with fourth quarter operating revenue that did go beat expectations, $1.84 billion. Estimates are for $1.77 billion. Fourth quarter adjusted earnings per share also coming in above estimates, way above estimates at $2.42. Estimates for $1.27. We got Airbnb.
All right, let me take a look at this. We have fourth quarter EPS, 73 cents, beating the consensus estimate of 59 cents. Fourth quarter nights and experiences booked 111 million, slightly higher than expected as well. Adjusted EBITDA, $765 million, almost 100 million more than what was anticipated. In terms of the outlook for this quarter, it sees first quarter revenue anywhere from $2.23 billion to $2.27 billion. Analysts were looking for $2.29 billion. So that is a miss on the revenue outlook for this quarter. Once again, the revenue coming a little bit light. The stock right now is higher by more than 7% in after hours trading. There's a lot of concern about the strong dollar and what it means for the international business, because certainly Airbnb very exposed to that.
Just going back to Applied Materials for just a moment. So clearly they did beat estimates, but their second quarter net sales came through here, and it was a miss, coming in at about 7.1 billion versus 7.22. So that miss there, taking a look at Applied Materials.
I want to layer on top of that because there were some concerns about Chinese export controls, and they do say in the press release, this is the Senior Vice President and CFO, for the second fiscal quarter, we're encouraged by the trend supporting continued customer investments to enable leading-edge technology inflections while also taking into account export control-related headwinds. So there might be a little bit of concern and disappointment on that.
Yeah, and this is going to be, when we get to these conference calls, I mean, these are the questions that are going to be peppered, that the executives are going to be peppered with. I do wonder, though, about their exposure. I mean, it didn't really seem that high to begin with, and at least seemed like there was some adjustability that if they needed to pivot.
There was an analyst note that had said that Applied Materials had de-risked from China to now, the low 30% of revenue in the second half of last year. That's compared with more than 40% in the first half. So you wonder how much room there is to de-risk further. And that's certainly a theme that we've been hearing from companies throughout this earnings season.
Well, and they definitely cited it in the release, at least a little bit. Sorry.
No, that's right. All right. We also have Yelp earnings coming out as well. I'm just bringing it up right now. So Yelp actually beat estimates for its net revenue for the fourth quarter, coming in about $362 million. Solid beat. Earnings also looking real strong, coming at 62 cents a share versus 37 cents. But I don't know if that necessarily is comparable because that's a big spread.
Twilio out with their earnings as well. Those shares down in the post-market trade. Adjusted EPS, a slight miss. They're coming in at about $1 even. The street was looking for $1.03. Fourth quarter revenue coming in at $1.19 billion. The street was looking for $1.18 billion. So it looks like a slight beat on that metric here. The company, though, also reiterating, basically going to stand by the previous financial targets that it gave for the full year fiscal 2025, which includes organic revenue growth of about 7 to 8% year over year, of course, on a non-GAAP basis.
And interesting because remember, Twilio also pre-announced just on January 23rd. Hey, Palo Alto guys, let's get to it. Second quarter adjusted EPS, 81 cents a share, 3 pennies light compared to what the street was expecting. Second quarter revenue is $2.3 billion. That's a little bit better. $2.24 billion was what the street was expecting. Going to the third quarter, the outlook, it sees third quarter adjusted EPS of 76 to 77 cents a share. Folks, that's light. The street's looking for 80 cents and sees third quarter revenue, $2.26 billion to $2.29 billion. And the estimate on the street is $2.27 billion. We're seeing shares of Palo Alto just down about 1% here in the aftermarket.
And I'm looking at shares of GoDaddy. They're kind of jumping all over the place. The company did report fourth quarter revenue that beat estimates just barely. Fourth quarter earnings per share, though, coming in at shy of estimates at $1.36. As far as the outlook goes, the company sees the first quarter well in line with estimates, $1.18 billion to $1.2 billion, estimates for $1.19 billion, so smack dab in the middle there. And also seeing the full year outlook for 2025, $4.86 billion to $4.94 billion. The estimate was for 4.9. So kind of in line when it comes to the outlook for the year and for the first quarter. Shares at GoDaddy right now, just higher by 0.2%.
All right, let's move over to the crypto exchange Coinbase. It had a revenue beat for the fourth quarter, $2.3 billion versus the consensus estimate of $1.87 billion. Transaction revenue also higher than anticipated at $1.6 billion. And in terms of the outlook, it says it sees first quarter subscription and services revenue of anywhere from $685 to $765 million. For the fourth quarter, that number came in at $641 million. So that is a build on the fourth quarter number, which, by the way, was higher than anticipated.
All right, a lot of movement. Applied Material down about 3.4%. Roku up about 13%. Palo Alto, also some movement there. And Twilio down about 9.6%. So again, seeing some stocks move here in the aftermarket. Palo Alto down about 6.5%. All right, guys, that's a wrap. A big earnings after the closing bell here. Your cross-platform radio, TV, YouTube, Bloomberg Originals. I know, Alex, you're heading out. Scarlett's continuing with Romaine. Tim and I continuing here on Business Week. We'll see you again, same time, same place tomorrow.
Our coverage continues here on Bloomberg Television with a deeper dive into that fire hose of earnings. First, a look at Applied Materials. Stacy Rasgon, senior analyst of U.S. Semiconductors over at Bernstein, going to be joining us after the break. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. A near record day for U.S. equities. Not quite there, but I want to start where we started the day here, because it looked like things were going to be a lot worse here. A lot of talk about new tariffs, reciprocal tariffs, if you will. But once we learned the details of President Trump's plan, the market seemed to take it as, well, a bit of a soft shoe. The idea that the worst is not here, and maybe the worst might not ever come. The S&P finished the day higher by more than 1%, right at that 6,115 level, just about 3 points shy of its record high. You saw similar moves in the other indices, and a big part of that reason, too, is reflected on these last two lines on the screen. Massive weakness in the dollar here on the day, and a big drop in yields on the day, providing a little bit of an aid to that equity trade. And that was really evident. We saw that in automakers, of course, really exposed to a lot of this tariff talk. A bit of a relief rally here, up 5% on the day, a 2-day run for this group. And remember, Scarlett, this isn't just automakers. This is all those parts makers and other folks who are camped out on the other side of the border, who are really worried right now about what might come out of Washington.
All right, but for now, the word is delayed tariffs until probably April. So as a result, a lot of time between now and then. Let's take a look at some of the notable movers in after-hours trading. We're going to start with Airbnb, the home-sharing platform, gaining about 13% right now. This is after fourth quarter revenue and EPS beat analyst estimates. Even though first quarter revenue did miss, its first quarter revenue outlook was a little bit lighter, so we'll get into some of that later on in the hour. Roku gaining about 14%, 15% in after-hours trading. This is after its fourth quarter revenue did beat analyst estimates slightly, and its first quarter outlook pretty much matches the consensus. And Applied Materials currently down about 3%. This is the semiconductor equipment maker. It had a first quarter adjusted EPS that beat analyst estimates, but the outlook for this quarter when it comes to sales was a little bit light, $7.1 billion versus analyst estimate of $7.2 billion. Romaine?
All right, Applied Materials shares are down about 3% right now in the after-hours trade. Stacy Rasgon joins us right now from Bernstein Research. And Stacy, this report wasn't awful, but when you take a look at the guidance, I am curious as to exactly what you think is going to help drive this company and, more importantly, the stock.
Yeah, you bet. So I bet it has to do something with China and the export controls. So the quarter I'll beat a little bit. It was kind of in line that the China revenues went up slightly sequentially, which I don't know if that was expected. I'm not that surprised, though. If you look at the import data into China, there was a spike in equipment imports. We've done some of this work in December, right in front of the export controls. Mm-hmm. Those export controls take effect end of December, and so that'll influence AMAT's next quarter guide. And they even called out, if you read like the narrative up front, they talked about the potential impact, at least qualitatively, about export controls on there. So my guess is that maybe what's driving it. One more thing, if you actually look at the pieces of the guidance, the equipment guide actually looks kind of in line. It's the services guide that actually looks light relative to where I think consensus was. And they include a lot of the trailing node, like the 200 millimeter equipment that they were selling. A lot of that goes into China. That's in the services block. So again, I actually wonder if that's what's going on. If that's the case, I think it's nothing they can do about it. It's understandable. I think it's fine. In the meantime, the margins look good. Gross margin performance in the quarter was good. The margin guide is good. The EPS guide, even with the revenue a little light, the EPS guide is in line. Overall, I don't think this is a horrible print. I think it's okay.
Where does the company fit in, though, into the broader landscape, particularly with all of the talk about AI and data centers, et cetera, and the volatility around that? They haven't benefited, not directly, at least, that we can see in the stock. Does that change at all?
Well, to be fair, the multiples in the semi-cap space in general have come up, and some of that may be, AI narrative related, although I actually think they're just better companies. They probably do deserve to trade higher than they did in the past. The equipment names should benefit from AI, and they have. There is the, how much leading edge wafer demand does AI drive? And frankly, it hasn't driven that many wafers yet, because the actual units aren't that many. We're in the millions versus, we sell, over 1 billion smartphones a year. Mm-hmm. But that number is ticking up. And where they have been benefiting more is on the advanced packaging side. It uses, most of the AI chips use a packaging technique called CoWoS, and they benefit from some of that. And they also benefit on the memory side. They use something called high bandwidth memory, which is a type of DRAM, and AMAT and others have a lot of exposure there as well. So I wouldn't say that there's been no benefits from the AI trend.
All right, I just want to jump in for a moment here because we also have earnings out from DraftKings. Very different company, obviously, but just a quick recap here of the numbers. Fourth quarter revenue basically matching analyst estimates at $1.39 billion. Adjusted EPS, 3 pennies better than anticipated at 14 cents. And in terms of outlook, it has raised its 2025 revenue guidance, the midpoint at least, to $6.45 billion. Previously, it was looking for anywhere between $6.2 to $6.6 billion. DraftKings up about 5% right now. Stacy, I want to come back to you on Applied Materials because a lot of people are talking about Applied Materials being a beneficiary of TSMC spending, but at the same time, it's so reliant on that one company that actually creates a vulnerability. How are you thinking about TSMC and the China issue when it comes to Applied Materials? Is it, for the most part, a net positive?
Well, TSMC is not their only customer, but you got to remember, like, the spending in equipment is fairly concentrated, especially at the leading edge, right? There's only a few guys. You have Intel and Samsung and TSM and you've got, some of the memory players, Micron and those guys that spend as well. But there aren't a lot of customers. So any semi-cap player is going to have relatively concentrated end market or customer exposure, and TSM is going to be a big customer. So I don't think AMAT is hugely different from the broader group in that state. Now, the broader question of the industry is dependent on TSMC. That's a whole other question that probably we need more time to talk about.
Fair enough.
But that is an issue in semis in general, like TSMC and the whole industry is very dependent on TSMC for leading edge semiconductors, yes.
All right, Stacy, really appreciate your taking the time to give us your instant analysis on Applied Materials. Stacy is Senior Analyst of U.S. Semiconductors and Semiconductor Capital Equipment at Bernstein Research. We want to go back to the breaking news at the top of the hour. Airbnb also reporting. And, of course, you look at Airbnb shares, and they are higher at the moment. Fourth quarter earnings per share and revenue beat analyst estimates, and you can see the stock up about 14%. But the first quarter revenue forecast did come in a little bit light. So I want to bring in now Scott Devitt. He is equity research analyst at Wedbush. Scott, why is it that investors are looking past the revenue forecast when it's been all about the outlook for investors this earnings season?
Well, a few things. One, the quarter was particularly strong. The company beat gross bookings by 200 basis points. Secondly, that first quarter guide has a 400 basis point appreciation in the US dollar embedded in it. And numbers don't get updated throughout the quarter in such a way that it's a comparable number. So I would argue that 1Q number is more in line with expectations. And then third, and probably most importantly, there was a fear around the margin profile of this business going into an investment period. And the company in its shareholder letter noted a 34.5% EBITDA margin for 2025, which I think is ahead of investor expectations.
Okay, yeah, they do say that they plan to invest anywhere from $200 million to $250 million to start and scale businesses to be introduced later this year. Do we know what those businesses look like and whether they can contribute to growth right away?
So experiences will be the major launch this year. They've mentioned things like car rentals. There's going to be offerings like service integrations for cleaning and things of that nature. But the predominant spend relates to the relaunch of the experiences platform. And that's what we're driving the fear around the margin profile, which is why it's so important that the guide, even inclusive of that spend, is ahead of where we think buy-side expectations have gotten.
So when we talk about, Scott, some of these add-ons and the idea of what Airbnb is trying to do, is this revenue or the potential revenue they get from that, is that coming directly from the folks renting the properties, or is that ultimately going to come out of the folks renting out the properties, I should say, or is it going to come from the folks, the customers themselves?
It depends on the product offering. Something like experiences is incremental, it's ancillary, and it's an additional spend on behalf of the consumer. The company has mentioned that they have, as many as 5 different product offerings that they have in mind that can add as much as $1 billion of revenue per year. This experience is the first one. The burden for that, of course, because it's incremental to the room, would be on the customer or on the consumer. Other things that get added could be paid for by the host. It'll all depend on what they are.
Well, I'm just curious about what type of pricing power the Airbnb has right now, Scott. There's been a lot of complaints from folks who basically say, look, I can get a hotel room now at a more reasonable rate than I can with a comparable Airbnb property.
The gap's tightened over time. It's a preference thing these days. It's not really a price thing the way it was when Airbnb first came about. Kind of like consumers used to avoid paying taxes on Amazon purchases. That's not really the value proposition today. So I think as Airbnb is mainstreamed in society, the decision matrix is a little bit different. You have a family of 5, and Airbnb may be better than getting 2 hotel rooms. You have 2 people traveling that want to be in the middle of the city. A hotel could be better. And we're at the mainstream point right now. We had the benefits of the pandemic that helped Airbnb trying to stay away from other humans, and then we've kind of normalized on the back of that, and here we sit. And this is kind of the recovery period now for Airbnb coming out of that.
Scott, always appreciate it. Scott Devitt, equity research analyst over at Wedbush. A closer look at Airbnb, the second biggest mover in the after-hours trade. The number one mover in the after-hours trade right now is Roku. Those shares up about 15%. A full breakdown of the earnings that we just got out of the streaming platform. This is Bloomberg. Roku moving in the after-hours trade on the back of its earnings. Revenue coming in at about $1.2 billion in the most recent quarter, growth of 22%, and the company guiding for the first quarter what would amount to revenue growth of roughly 14%. Geetha Ranganathan joining us right now of Bloomberg Intelligence. And Geetha, let's start first with that revenue number and that revenue growth. Were you surprised?
Absolutely, yes. Very positive, solid numbers remain. And for Roku, really, yes, the total revenue is important, but you have to remember, again, it's broken out into what they call platform revenue, which is majority of it is, the advertising-based revenue. And then, of course, you have the devices revenue. Platform revenue is, of course, the most important number. It makes about 85%. That's where you have all of the advertising. That's where you have all of the streaming services revenue share. And really, the number that they had guided to initially was about 14% growth. They came out swinging with 25% growth. So that was really strong. And I think what is kind of really lending credence to the outlook as well is the 1Q guide, which is, again, fairly strong for platform revenue at about 16%. So really strong, just showing very, very good execution on all fronts.
Okay, and just a quick jumping in of some headlines. Morgan Stanley CEO Ted Pick's pay. It has been announced it is now $34 million. So Morgan Stanley CEO's Ted Pick's 2024 total compensation coming in at $34 million. We'll get you more context as we get it. Geetha, let me come back to you on Roku, because this company no longer reports the number of households that use its products quarterly, kind of in the same way that Netflix is no longer going to report its subscriber ad numbers. So what is the best way of gauging its growth then? What do they want people to focus on?
They really want people to focus very much like Netflix. This is now a top-line growth story. So revenue growth and platform revenue growth are going to be the most critical elements. And then, of course, they actually turned profitable. So adjusted EBITDA is also an important metric for them. They were supposed to be adjusted EBITDA positive for the very first time in 2024. That actually happened a whole year early. And then if you look at their guidance, Scarlett, for 2025, they actually raised guidance, or I should say their guidance came in about 20% above consensus estimates for the whole of 2025. So it looks like they're really making good strides on the profitability front as well. So I think the metrics there are going to be revenue growth and, of course, EBITDA as well as margin growth as well.
I am curious, is there any sort of risk here to the company with regard to kind of its statuses? I mean, we kind of call it the Switzerland of streaming here, but as it moves to sort of monetize its user base, come up with new content and basically grow the company, does that put it in conflict at all with some of the other big streamers?
Yeah, I mean, this has been a constant kind of pain point, Romaine, and I think the biggest problem really with this company has been competition. So you have competition on multiple fronts. Of course, you have competition on the hardware side. So Roku is the leading streaming platform. There's no doubt about it. They have a 30%, 35% share in the US, but you have all of these other companies that are really trying to gain ground. I mean, you look at Amazon with Fire TV, you look at Google with Chromecast, you look at the latest acquisition, which was Walmart going and getting, Vizio, which kind of really makes people, I think, nervous about anybody that has access to so much of data. They obviously can build massive scale in advertising. And then again, yes, Roku does have its own streaming platform, its owned and operated streaming platform with Roku Channel. But again, you have a whole lot of competition there as well. So I think competition is the number one factor.
Got it.
But they've managed to
Geetha,
do well.
We got to leave it there. Geetha Ranganathan of Bloomberg Intelligence. Coming up, we're going to talk about Trump and his tariffs with Tina Fordham. This is Bloomberg.
reciprocal tariffs, those two words, reciprocal makes tariffs really fair.
President Trump outlining his plans for reciprocal tariffs on a country-by-country basis, saying that reviews should be complete by April 1st, but beyond that, no real clear date as to when they would take effect. Joining us now to discuss is Tina Fordham, geopolitical strategist and founder at Fordham Global Foresight, typically in London, but here in New York with us. And I know that you've been traveling across the U.S. You were in Washington not so long ago. So a reprieve for the markets for now and for other countries as well, too. What do those countries do in the meantime as they prepare for the possibility of reciprocal tariffs as early as April 1st?
Just thinking about the word you used, reprieve. This is an example, I think, this pronouncement, but for a date in the future, of what a term we used to use talking about Putin, which is escalate to de-escalate. And so that's how I see this. This is rhetoric that kind of tries to set a new tone, a shot over the bow. How can anyone prepare? They can't prepare. I did a roundtable yesterday with 10 CEOs. They did not know whether they should buy supplies 3 months in advance, 6 months in advance, how to parse these statements. They're not used to having to do that. And these were U.S. CEOs. In Europe, where I'm based, there is utter confusion about what the intention is. What is this designed to bring about?
And right now, no one knows the answers to those questions.
No. Do they know the answers to these questions?
It's a good point. So companies talk about the need to de-risk China, and we've seen that take place over the last couple of years. Is the rest of the world de-risking the U.S.? Is that even possible to do?
Well, this is a concept that we've been throwing around at Fordham Global Foresight because, I mean, of course, the U.S. is the biggest consumer market in the world. No other market will be able to replace the U.S. And so it's a kind of a different concept, really, which is do we say former U.S. allies start to work around the U.S. at the country level because the U.S. is increasingly seen as an unreliable partner. We certainly see that at the firm level, where, of course, you're trying to diversify your risk, whether it's supply chains, tariffs, taxes. It's now a much more complicated equation.
It is a complicated equation, but haven't countries been trying to do this basically since the first Trump administration? Not necessarily with success, but we've seen some attempts at creating more regional alliances and just trying to find a way to be less dependent on the world's largest economy.
I would say that even though Europe, for example, has been on notice for some time about things like increasing defense spending, the idea that the peace dividend is well and truly dead has still been slow to dawn. And we've got German elections in a little over a week's time, where the German government has been very slow to want to spend on the military. And now the likely next German chancellor, Friedrich Merz, is in the very uncomfortable position of having to contemplate increasing spending. And this, Europe doesn't grow like the U.S. We can't. Finding the money magically to go to 3 to 4% is going to result in a lot of European governments collapsing.
When you're talking to people and you're doing your research, though, do countries see some incentive in trying to court Trump? Meaning, is there something that they can offer him to not only just get them off their back for 30 days, but to get them off their back for the next 4 years?
Of course, that's what we saw, the parade, of supplicants to Mar-a-Lago. I'm not the first person to suggest this is kind of an imperial presidency. In fact, I think I said on another Bloomberg show that this is the sucking up phase to Trump. But take a concrete example, Keir Starmer in the UK. Trump has said he likes Keir Starmer, even though he's the head of a center-left government. This is a problem for Starmer when he goes to the UK-EU summit dinner last week in Brussels because he's teacher's pet.
Well, let me just sort of rephrase the question. Is there alignment between these nations at all? I'm just talking in terms of ideology. I mean, I know there's personal relationships that are going to dictate a lot of how Trump deals with them, but is there any sort of ideological alignment from the major economies?
Ideology, no, I would not say. I think that countries are trying to avoid collateral damage or a direct hit from these tariffs because they are such a blow. So the VAT remarks from Trump today will hurt the UK massively. This friendly country that Trump had said, the UK is a much smaller trade balance problem
Right.
compared to others, but it does issue VAT. So no one understands how they can get on the kind of the right side of Washington right now.
You said something that was pretty provocative, the possibility of European governments collapsing. Just to take the other side of that, what are the odds that Europe comes out of this Trump era stronger, in a more competitive position, less regulation, more productive, even as they're spending more on the military and other things that they hadn't quite accounted for?
So as much as we're in the midst of this kind of bewildering maelstrom of policies and a change in stance from the U.S., I do think that there is upside potential. You would be a fool to say that Europe has been doing everything right. It is ossified. It does overregulate. It doesn't promote competitiveness in the way that it should. If shaking things up helps bring that about, then that's a great result. I remember that Bob Rubin, when I was at Citi, used to call me and say, Tina, what's happening in the museum economies of Europe? And, that's still not a wrong comment.
Yeah. Just only about 30 seconds, but I have one quick question, and this is about India and its role in all of this. It's done a relatively deft job in trying to navigate through this. It's made friends with China. It seemingly has a friendship with Trump and the U.S. administration as well. Is
Russia
it
as well,
one
too.
of the few countries that is actually doing this right?
Well, no, because Trump issued this announcement hours before he welcomed Modi to the White House, and India will be hit by this. So it's very uneven, and it's not clear how it will shake out. This is an experiment in real time in global politics and economic policy.
Well, it's keeping us all busy. Tina, I have to leave it there. Tina Fordham, geopolitical strategist and founder at Fordham Global Foresight.
All right, let's take a look at some notable movers in after-hours trading. Meredith, what do we have? Let's pull up the boards right now. DraftKings coming up, and you can see that stock is higher in the after-hours trading. And let's just give you the headline there from DraftKings. It has gained on a boosted annual revenue outlook. So the higher annual outlook is certainly giving a lift to that company. Palo Alto Networks, a cybersecurity company, down about 4% after-hours trading after third quarter adjusted EPS forecast, missing analyst estimates. I know you were looking at Twilio, Romain.
Yeah, this is the backbone of the internet, and you had a little bit of a miss there, and that's causing a little bit of concern, though. And we sort of overlay that with what we learned out of Palo Alto Networks and this idea here that where is the spending going? A lot of that spending is being sucked into sort of that AI and data center trade, and there are consequences as the companies that aren't at the center of that take a hit.
And Coinbase jumping all around. It was higher earlier, now down about 1%, even as profit and revenue did get a big boost during the Trump rally after the election. This is The Close on Bloomberg.
All right, 2024 wasn't necessarily a great year for brick and mortar retailers, and 2025 could be even worse. Retail pressures ramping up with new data out from Coresight Research. They estimate 15,000 stores will close over the course of the year. Deborah Weinswig is the CEO and founder at Coresight Research, and I'm pleased to say that she joins us right now. And Deborah, we've seen a lot of companies already make announcements about a bit of a scale back, whether it's Macy's, Kohl's, Best Buy, and then of course you have bankruptcy and liquidation stories, the Party Cities of the world as well. When we add up these 15,000 stores that you're projecting to close this year, are they primarily going to be concentrated in certain areas? Are we talking about department stores? Are we talking about apparel? What?
First of all, thank you for having me. I really appreciate it. But secondly, what's interesting is they're not as concentrated as you might think. Right? We've had a fairly sluggish housing market, and so we would have expected to see more there, kind of a la Container Store. But it really is pretty broad if you think about, Bargain Hunt, Liberated Brands, Party City, Big Lots, and now, with Joanne announcing 500 or so, the 800 stores, it's really widespread, and I think that's what's telling us that there's something more going on.
Is this sort of a loss of customers and, for that matter, revenue, or is this a shifting of those customers and revenue to other areas, either other brick and mortar stores or to the online businesses?
So what we're seeing in terms of where consumers are is that they are looking for a frictionless, gamified, kind of fun shopping experience, this idea of like shopping as a sport. And I think that, in a lot of the research that we've done, people are waiting in line, they can't find somebody to help, they can't find somebody to check out. And so they actually are usually in the physical store either at the beginning or the end of the transaction. But if you're not there for longer, or if you're just kind of looking to check out, you may not be buying that kind of impulse item. And what we're seeing as well, which is very interesting, is Gen Z, right? In the kind of like call it the 18 to 25-year-olds, obviously a tenured generation, but they're much more physically oriented. So about 70% of them are culminating their transaction in physical versus 40% of millennials. So I think we are going to see a big shift. But the retailers also really need to move to where the consumer is too.
Yeah, and a lot of the Gen Z impulse buying is on food and drinks as well, which is a different category altogether than merchandise. Deborah, I want to ask you about Shein and Temu, because you mentioned them a couple of times in your notes and how perhaps they're under-recognized, the risk that they pose to existing retailers. Walk us through this a little bit, because you never hear the companies themselves talk about it, but how have they had to adapt with the popularity of Temu and Shein?
If you think about it, you have two new entrants, and if you look at GMV, each of them are about $50 billion, and obviously Temu got there much faster than Shein. And they're competing at Temu in many of these, kind of home, party, let's call it items under $10. You also are seeing Temu where they have gamified the whole experience. And they're very generous with returns. It's very clear. And, I would say on the customer service side, they go above and beyond. And then with Shein, you have not only apparel, but they've gone, they're really creating a marketplace. And so you're starting to see other brands on their platform. And those brands will be selling at full price, be completely sold out on their platform, and on their own platform, they have inventory available. And so that idea that, it's fun, it's interesting, the merchandise is changing very rapidly. And so I think that kind of that excitement around shopping, we've got to get back there again.
Yeah.
And I think that, think about the the Kmart Blue Light Special, like those were fun days. And so I think we'll start to see more of that hopefully in the near future.
So why isn't inflation affecting Shein or Temu more? These are not expensive items that they have on their websites. I mean, I bought some shower hair drainer on Temu, and the item itself was $2. The shipping cost a lot more, but I got it, and then I got a bunch of follow-up emails about, playing some game, to your point about gamifying things. Why isn't inflation a bigger factor? And, I mean, will tariffs be the thing that actually knocks them out of contention as real competition?
I think that if you think about it, they're really looking at like penny profit. It's a volume game. So as long as they're really making a penny or two per item, and that's very different than for US retail. So even with the de minimis and tariffs and whatnot, that's why we believe that a lot of this kind of pressure on US retail is here to stay. And, we are seeing some signs of innovation and kind of breaking out, right? I mean, you've got some retailers like, it's probably not the ones you would even think, like Tractor Supply, Sprouts. I mean, we're seeing Boot Barn. I mean, they're opening a lot of stores, right? You see customers stay in the store. There's long dwell time. And so I think it's just starting to see real innovation in physical retail, and it's hard and it's expensive. But that, I think, is what will ultimately save. And, these retailers are going to have to coexist alongside Shein and Temu.
Yeah.
But I think figuring out how to get that physical and that personal relationship, that's the opportunity.
All right, Deborah, really appreciate your joining us. Deborah Weinswig, is CEO and founder of Coresight Research. Now, one of the hottest items on the e-commerce market is changing its strategy to prepare for potential tariffs. The Bogg Bag, which gained a lot of popularity through social media, has sold more than 4 million products across Amazon, Target, and direct-to-consumer from its own website. Bogg Bags have inspired a cult following from mothers and caregivers who are looking to stay organized and, of course, stay stylish, too. But the threat of tariffs could impact its supply chain. Here in studio with more on the rapid rise of Bogg Bags is Kim Vaccarella. She is founder and CEO of the company. Welcome back.
Hi, thank you for having me back.
So the concept behind Bogg Bag was born in New Jersey, the Jersey Shore specifically, yes. But it is actually made in China. And I'm wondering, is this a product that could be made in the U.S.?
We've searched for various manufacturing capabilities within the United States. We've been unsuccessful to date. That doesn't mean that it won't happen ever. And with these new round of tariffs, it may be something that we're looking at. But right now, our focus is on, the immediate future and with the tariffs.
Fair enough. How are you preparing for that immediate future with the tariffs? Have you preemptively increased your orders before President Trump took office? Are you ordering 3 months in advance, 6 months in advance?
Well, we're constantly ordering. We have orders on the containers on the water every week. What we have done is we traveled to Sri Lanka, to Vietnam, actually recently, to look at the capabilities there to see if they can do what we need them to do in those countries, which would save us a substantial amount of money.
What's the cost, though, to make a shift like that, particularly for a smaller size business?
It's extremely expensive because in our particular case, it's molds, and molds can be very costly. And we need to run our production, we need hundreds of molds. So having those produced, having them shipped over, because they're not made in Sri Lanka and they're not made in Vietnam or Cambodia or any of the other places that we're looking at. So we're having to move all of these molds to these locations, set them up, make sure that they have the machinery and equipment available there, and the people.
Well, talk about the people and the expertise. When you were setting up shop in China to get your manufacturing done there, what was that process like? And can that be replicated in these other countries? Because that's been the argument for a while, saying that China just doesn't have cheap labor. It has an expertise in that labor as well.
Right. In our particular case, in EVA injection molding, all of the countries have been doing it for many years in shoes, right? So they already had an in as it relates to manufacturing that type of material and product. So that part is okay. You're just not, in some cases, you're not seeing the quality. So that's a work in progress. You need to make sure you're working with them, make sure that you're giving them the right parameters that you need.
How do you monitor that? Do you have to physically go over to those countries to monitor, or can you do that remotely?
I've been there, but also we'll get samples and just make sure that the samples are in line with what we're looking for as far as quality.
When you look at the Bogg Bag collection, it's all made from EVA, the ethylene vinyl acetate. It's light, foamy, bendable, moldable, and antibacterial as well. It's basically what's used in Crocs. How do you source the material, and are there options on that front to source it?
Currently, as far as I know, a lot of the material will still come from China. So you kind of have that catch-22. You're going to move out of China, but you're still going to rely on China for all of your materials, your machinery, and in some cases, a lot of the production. So even when we went to Vietnam, a lot of the people that work in the factories there are Chinese, and they're bringing over their expertise. Right. So there's a lot of different things to look at.
Yeah, not only work there, some of those factories are actually owned by the Chinese, but that's a whole nother conversation. Speaking of which, have you ever thought about doing a partnership with Crocs? Because I look at the holes on the bag and I look at the Crocs, and then it's the same materials. Couldn't you just create those I forgot what those little charms that they put on the shoes?
Well, we have decorations for the bag. And we've had a conversation once or twice before, but we're doing bags and they're doing shoes, and all is right.
Yeah, just real quickly, we only have about a minute left, but who's your main consumer, your main buyer right now?
So, it started with mom and it continues with mom, but we run across all different subsets there. So it's the mom, it's the teacher, it's the nurse, anybody who wants to stay organized, that's spending a lot of time outdoors with family, with kids, where there's messes involved. The greatest thing about Bogg is you can just hose it off and hang it up. So it makes it very easy to use.
All right. Well, a great story and obviously a great product. Kim Vaccarella, founder and CEO of Bogg Bag. Stick with us. We're going to set you up for what to watch over the next 24 hours. This is Bloomberg. Another interesting day on Wall Street. It looked like we were actually headed for maybe a lower day here. Then it looks like, I guess, maybe because Trump didn't impose those tariffs and maybe it was a little squishy on it. The market rallied. We almost had a record high on the S&P today.
I know, and we rallied into the close as well, closing near session highs. I guess a delay in the tariffs until at the earliest April 1st is enough for people to say, that's okay, we'll just move on ahead.
Yeah, I don't know if it's whistling past the graveyard or maybe the market knows something we don't. Of course, the market also being driven by fundamentals. We got earnings today, and we're going to get some earnings tomorrow as well.
Yeah, Moderna is going to be reporting reporting. This is a stock that's down about 25% this year, and it's one of the most shorted companies out there as well.
Well, everyone wants to know kind of what's next for them. Obviously, they hit it big with that COVID vaccine, but I don't think anyone's giving COVID vaccines anymore.
No, I can't think of the last time someone actually talked about that, at least to me. Air Canada is also reporting, and of course, it's going to benefit from a weaker Canadian dollar. So we're going to take a look at how that all translates out.
Now, because of the trade war, are they allowed to fly across
that is a good question.
into the U.S.?
I mean, I don't know how many Canadians want to come into the U.S. right now. They're booing us when they play the U.S. national anthem at games.
Yeah, don't even start, Scarlett. Anyway, in all seriousness, though, we also have some interesting economic data. We were just talking, of course, with Kim Vaccarella over at Bogg Bags, and of course, Deborah Weinswig over at Coresight Research. A big focus on retail sales.
Absolutely, because it all comes down to the consumer, and if the consumer continues spending, that is the backbone of the U.S. economy, and of course, that means that we can continue to look at these stock prices hold on to their gains because earnings are coming in.
But did you see the economist estimates? I mean, you're looking for basically a drop on a year-over-year basis, and I think even a negative sign on a month-to-month basis. So definitely a little bit of a deceleration in spending. Maybe just for 1 month.
Maybe just for 1 month.
And maybe that's kind of the hangover from the holiday
January doesn't tend to be a
season.
strong retail sales month, right?
But we'll see if that persists, and we'll see if the market freaks out over it or not. Maybe we get some calming, soothing words out of Fed members. We get Fed speak tomorrow.
Yeah, Lori Logan will be speaking, but she's not a voting Fed member. She doesn't vote until 2026. So whatever she says is going to be interesting to the debate over what happens next, but maybe not as market moving as others.
All right. Well, what could potentially be market moving is we start to get the deadline for those 13F filings. Backwards looking, but we know there was a lot of activity in the last quarter. Be interesting to see what hedge funds owned then and maybe what they don't own now.
Yeah, especially because a lot of hedge funds were dialing down their exposure to U.S. stocks, but then towards the end of these past couple of weeks, they start to ratchet back up again. So a lot of trades, of course, it's a snapshot in time. It doesn't really tell you where they are right now, but it's interesting nonetheless.
But it gives you some insights into where their head is at, and we'll have all those insights for you every day right here on The Close. For all your political coverage, stick around. Balance of Power is up next.